Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's switch our attention back to the geopolitics, the story of the last 48, 72 hours, what's happening in the Middle East. Aaron David Miller joins us. He's a senior fellow at the Carnegie Endowment for International Peace, joining us from Washington, D.C. via Zoom. Aaron, thanks so much for taking the time here. Again, it's front and center here for not just geopolitics, but also for financial markets, and that's why we here at Bloomberg are paying close attention to what's happening in the Middle East here. We had the Iranian attack yesterday. I'd love for you to put that attack into context of what is happening in the Middle East overall. What's next for Israel?
Yeah, you got. Thanks for having me. You've got three wars of attrition going on. One between Israel and Hamas, Israel and Hezbollah, and Israel and Iran, which is the premier event here. And over the last several weeks, as a consequence of Israeli actions in Hezbollah, the balance of power in these three wars of attrition has fundamentally been altered. Hezbollah is a mere shadow of itself. Israelis estimate they've eliminated half of its high trajectory weapons inventory. And those weapons were designed by Iran in order to provide a contingency in the event Israel or the U.S. attacked Iranian nuclear sites. Well, that's more or less degraded. So the Iranians needed to find a way to respond, both to the Israeli assassination of Ismail Haniyeh on July 31, the leader of Hamas. Israelis didn't claim responsibility for that yet. And, of course, the most recent hit on Hassan Nasrallah, the head of Hezbollah. So they looked for a response that did more than what they did in mid-April. You recall when they launched 300 high-trajectory weapons of Israel. Most didn't even impact Israeli airspace, but not to trigger a major Israeli escalation. I don't think they found the sweet spot. 180 cruise missiles, even though Iron Dome, David Sling, Arrow intercepted a lot of them. U.S. Navy, 2 destroyers, took down 12. The Jordanians participated. Too many got through. And there were 2 Israelis were lightly wounded, and ironically, a Palestinian man from Gaza who was in Jericho was killed. But even though there were no casualties of a consequential nature other than the unfortunate death of the Palestinian man, the Israelis now have to respond at least portraying their thinking, to avoid creating a new normal, a second time the Iranians have struck Israeli territory. And they're going to respond. Biden's going to talk to Netanyahu today before the Rosh Hashanah holiday. But I think the Israeli responses are going to be heavy. Multiple targets, oil export facilities, Iranian Revolutionary Guard Corps command and control, conventional military sites. The nuclear piece, fascinating.
Yep.
I'm sure the argument's being made that now is the time for any number of reasons. I'm thinking, though, coordinating with the Americans, I don't think the Israelis are going to go after the enrichment facilities very deep underground, but we'll see.
Well, you mentioned that, the enrichment facilities under mountains, in fact. Is that even targetable at this point with with airstrikes?
Right. Well, you need bunker busters. You need shock and awe, which only the U.S. military can actually deliver. You need a degree of saturation and redundancy, despite Israel's skill and operational capacity, the Israelis don't have. Nonetheless, I still wouldn't rule it out as part of the target set. And then the question is, of course, how and in what fashion will the Iranians respond? I mean, without much imagination, you could envision a hop, skip, and a jump to something the Middle East has never experienced before, which is a multi-front war.
Right.
Not with the deployment of thousands of ground forces, but UAVs, AI, cyber, cruise missiles, ballistic missiles, one-way attack drones. With Iran, if it's hit badly enough, going after Saudi oil producing facilities, which they did, as you recall, in 2019. So we're closer. I'm still not convinced we're going to get there. Iran's weak, and it understands the asymmetry of power which it faces.
So, Aaron, I'd love for you to kind of give us maybe your assessment of where Prime Minister Netanyahu is in terms of his thinking these days. I guess we started this war almost a year ago with the attacks on Israel, and I guess at that point, Netanyahu said, hey, our goal is to incapacitate Hamas and get our hostages back. That scope seems to have broadened dramatically now to include, maybe some war aims in Lebanon, to deal with Iran more broadly. Where is he now?
Look, I think, never write this guy off. I mean, it was unimaginable that a prime minister who presided over the single bloodiest days for Jews since the liberation of the Nazi death camps, the worst intelligence failure in the history of the state of Israel, on trial for bribery, fraud, and breach of trust in a Jerusalem district court now 4 years running, would have gotten himself into a situation where his credibility and even some of the numbers in the latest Israeli polls have gone up. Not surprisingly, because of the last several weeks and what I think we're on the cusp of with respect to an Israeli strike against Iran. So he still does, if elections were held today, he still doesn't have enough seats to put together a coalition. But there's no effective opposition. And the fact is the Knesset's out of recess until the end of October. Benjamin Netanyahu will make an assessment on November 5, who the next president of the United States is, and he'll adjust his tactics accordingly. I don't see new elections in Israel at the earliest, and the government could go to term 2026. I don't see new elections in Israel until sometime in 2025.
Well, what's the response from the rest of the Mideast, Saudi Arabia, et cetera?
Well, there's the public and the private response, right? I mean, nobody is going to miss, other than Hezbollah, certainly among the Sunnis in the region, no one's going to miss Hassan Nasrallah. Certainly the Saudis won't. And Sunnis in Syria that have prosecuted a terrible war against Sunni populations isn't going to miss Nasrallah either. So, and that goes, by the way, also for Yahya Sinwar, the preeminent Palestinian leader who's hiding in a bunker somewhere meters below ground, probably surrounded by hostages below Rafah on Yunus. I think the Arab states really understand what they didn't in the wake of October 7th, when Israeli military capacity seemed to be not just diluted, but somehow defeated. The last several weeks, the operational effectiveness, the tactical ingenuity of the Israelis has restored, I think, their street cred when it comes to the Arab world. That's particularly true for the Bahrainis, the Saudis, and the Emiratis, who all have above ground and below ground security and intelligence relationships with Israel. But again, it's the Middle East. Nobody ever lost money betting against peace and stability. And I think that we have to still be pretty sober here. Yes, can what the Israelis have done be translated somehow into political arrangements? Lead to greater prosperity and stability. That's the core question, and it's one of the many questions I just don't have the answer to.
All right, Aaron, thank you so much for joining us. We really appreciate getting some of your time to share in your expertise. Aaron David Miller, he's a senior fellow at the Carnegie Endowment for International Peace, has decades of experience in that part of the world. We appreciate getting some of his time.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix here alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our Interactive Broker studio right here in Midtown Manhattan. So last night, Democratic Governor Tim Walz and Republican Senator J.D. Vance sparred during the CBS News vice presidential debate in New York that featured fireworks over abortion rights, the economy, and foreign policy, in part in an appeal to Midwestern voters.
One thing that Joe Biden did is he continued some of the Trump tariffs that protected American manufacturing jobs. It's the one issue where Kamala Harris has run away from Joe Biden's record.
Well, Kamala Harris's day one was Donald Trump's failure on COVID that led to the collapse of our economy.
If Kamala Harris has such great plans for how to address middle-class problems, then she ought to do them now.
How is it fair that you're paying your taxes every year and Donald Trump hasn't paid any federal tax in the last 15 years?
Well, joining us now is Henrietta Treyz, Managing Partner and Director of Economic Policy at Veda Partners. Henrietta, did we learn anything last night?
Well, we learned that maybe both parties' candidates have the potential to improve their standing with the American voter. The surprise to me was that flash polls that came out right after the debate showed that viewers considered the two men effectively tied in the race. I thought personally that Vance had exceeded Walz, but that's not what we saw in the flash polls. And most importantly, amongst unaffiliated voters, not Democrats, not Republicans, but sort of third-party voters, the majority of them thought that Walz did a better job. And you have to think of that as probably some of the last moments of the campaign, the debate, the last sort of 15 minutes when they talked about January 6th again. But in general, net, both candidates' standing improved materially with voters. I want to say that J.D. Vance went from a negative 22%, a negative 13% rating to a negative 2% rating. And Tim Walz also improved from his +3 favorability rating to something like +34 after last night's debate. So both men did what they wanted to do, introduce themselves to the American public, and the American public liked what they saw.
Henrietta, can you give us a sense? I'm trying to get a handle on this particular number. How many independent voters are each candidate trying to get at, each campaign trying to? I mean, do we have a sense of how many they are?
Well, the independent voter base is actually a huge chunk of the pie as America has gotten polarized and voters have, flocked to the far left or the far right within their parties. A big chunk of America now qualifies themselves as independent voters. That's different than undecided. Undecided is now like 4%, 7% of the electorate. Most people have picked a horse and they're moving forward. Unfortunately, most likely the people who are undecided did not even watch last night's debate. So they're going to be getting their internals from what they see on the internet today. And it's probably not going to move the needle too much. If you have to think about the presidential debate not moving the needle a whole lot, a couple points to Kamala Harris, it's very unlikely to me that the vice presidential debate last night is going to really change things for either ticket.
So it's October 2nd, if I'm not mistaken. And typically we talk about an October surprise when it comes to the election. Is the Iran-Israel conflict right now that October surprise?
I want to say yes. Obviously, the escalation that we're looking at right now and potential for the Middle East disruption is explosive to the point where we haven't seen it in decades. And, rapidly escalating and just waiting for Israel's response now. But the question last night was the first one out of the gate about how to respond to Iran. And I think what was interesting is that the electorate as a whole in America doesn't consider this a near-term issue or even something that ranks in the top 5 areas that they care about. It's, the economy followed by some combination of abortion and immigration, and then everything else sort of way underneath that. Foreign policy is just not a forte of American voters.
Henrietta, Kamala Harris has been out fundraising former President Trump. And in past election cycles, that would be really big news. Is that big news this time around?
I think it is. And I want to tie in a couple different components here. We have Hurricane Helene that went straight through Trump country in the panhandle of Florida, Georgia, and North Carolina, with the exception of Asheville and like a couple of blue pockets. But the turnout campaign, not just on the day of the election, but right now, as early voting has started, is something that all this fundraising is able to actually do. Kamala Harris's campaign has, a dozen field offices in certain states that are going to be pivotal to this election, where Trump has almost none. There are campaign volunteers that are getting paid $20 an hour to go out into the field and make sure that they're knocking on doors and getting people to the polls, getting their mail-in ballots sent. That's the kind of money that's being spent right now. And you're seeing it trickle down into the state races, which are now expanding the Democratic map into places they have no business being, Texas, Florida, Nebraska, and then also on the House side with an expansion of the race sort of exponentially in the last couple of weeks. And that's because of the massive fundraising campaign that the Harris campaign has generated. I think it's, if my memory serves, 287 million in August to Trump's 84 million. So they're tripling their numbers.
$20 an hour for volunteer. That's pretty solid.
Your attention.
Like that's
Then
something. You know
that
what
doesn't
I'm saying?
make them a volunteer, does it?
It is true. That feels odd, but maybe it's for-profit volunteering. Henrietta, when we take a look at the broader race in terms of Congress, Senate, and the House, where do we stand? What are some races that you're watching?
Well, I mean, my favorite part of this election is that we have the benefit of every single swing state also having a Senate race happening. I want to lay out two that I think are really important today, and maybe the VP debate can move the needle. In Arizona and Nevada, you see Kamala Harris's strength coming from the fact that she's pulling 13 to 15% of the Republican voter base. So in Arizona, 15% of voters that identify as Republicans are saying, you know what, not today, not for Trump, not for Carrie Lake, who is the Republican Senate candidate there. They're going for Galeo and they're going for Kamala Harris. And that's why she is even playing ball in a state like Arizona that used to be deep red. And that's translating just next door to Nevada, where you're seeing strength for Kamala Harris amongst Republican voters. And that's translating down ballot to Jackie Rosen in that Senate seat, who's ahead by 10 in the latest polls on average, if I'm not mistaken, something like that. So the Senate candidates down ballot for the Democratic Party are pulling so far ahead of Kamala Harris, so far ahead of their Republican challengers, and not all of them are incumbents. Whether that's in Michigan or other states, there are Democratic Senate races being held in all these pivotal states that Kamala Harris must win. And I think it portends either a massive split election or additional votes that Kamala Harris can get in the final days of the campaign.
All right, Henrietta, thanks so much. We really appreciate it. Henrietta Treyz, Managing Partner and Director of Economic Policy at Veda Partners, joining us there. You early voted already, didn't you?
I did. I just noted it yesterday, early and often. I'm a big believer in that. And I'm also happy that I'm not in a swing state. John, we're not in a swing state, are we, in New Jersey?
Well, don't say your vote doesn't. Every single vote counts,
It
Paul.
counts. It
Let's
counts.
emphasize
That's why
that.
I dropped it early and often.
Even though we're in New Jersey.
So, but in New Jersey, we're not a swing state, so we're not getting crushed by the political ads yet. But
No,
even
not
the
at all,
national
yeah.
buys are noticeable,
Yeah.
But I mean, when you get in a swing state, every local buy is,
It's
on
huge.
every station, you can't
I
get
know.
away from it.
I can't imagine. I mean, I've always lived in New York, so I literally can't imagine.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Looking at the markets here, I mean, again, you could say, given the geopolitical tensions, maybe this market's behaving fairly well, over the past couple of days. As John was just mentioning, we do have a little bit of a sell-off here, off just about 0.2% on the S&P 500. But the question is kind of, how do you thinking a little bit more long-term as you try to think about the geopolitics, maybe even the strike of the dock workers and the economic impact that could have? How does that impact intermediate to longer-term views? Let's check in with somebody who does this stuff for a living. Ann Bartels, Chief Investment Strategist for Sanctuary Wealth. Ann, with a name like Sanctuary Wealth, I'm thinking you guys think long-term, maybe relatively low levels of risk. What's your investment view of markets these days?
Oh, I can't get more bullish.
There you go.
And I understand that there's a lot of geopolitical risks. We have a port strike. We have an unprecedented presidential election. But what I've learned in my 40 years is that liquidity trumps everything. And the Federal Reserve is on an aggressive path, in my view, of now easing monetary policy at a time when our economy is growing. We're growing at least about 2%. I would argue we're still at full employment, and we still have corporate profits growth. We're not even in a recession for corporate profits. That this is going to ignite our economy, maintain employment, and I'm pretty bullish. Now, that's not to say that the markets can't be a little tricky or spooky in the month of October. But what the month of October has that most people don't talk about is we make important market bottoms that allow the market to have its strong year-end rally.
Where do you think the best opportunities are now? I mean, we've had some rotation in this marketplace. It's no longer the big tech stocks that are leading us higher. We've had some rotation in some other sectors. How are you positioned?
So that's really a bullish thing, that we have the breadth of the market expanding. So when we recently had new record highs in the market, breadth hit a new high. We got volume expanding. That tells us we're in a very strong market or a very strong tape. I haven't given up on tech. I think tech is in a consolidation. It's had an extraordinary move, but it's allowed other pockets of the markets to move. Can you believe that utilities could rally 20% this year? As the market is expecting rates to come down, they're seeking out yield within the equity market. You've seen moves in REITs. And it might be possible next year that the phrase or word TINA comes back. There is no other alternative as the market continues to seek out yield as the baby boomers move into retirement.
So, I mean, we've seen some volatility. I mean, we have the VIX now, just still below 20, but it feels like there's been some volatility in these markets when you talk to a lot of pros out there. How do you deal with that? Are there sectors that maybe protect you from that, or are there other ways to look at maybe getting a little bit of stability in a portfolio?
So, I mean, the true way to get stability in a portfolio, if you really want to be very defensive, is to own cash. And the market's already positioned there. We have $6.4 trillion in money market funds. Many clients have tried to lock in that 5.5%. I would argue that the market is extremely defensive. But, pockets of utilities tend to be very defensive also within the marketplace. Another bright spot is we have gold that's recently been hitting record all-time highs. So, you can put a little bit of gold in the portfolio because I do think over time we are more in an inflationary environment. Although we're seeing inflation come down now, and I think into next year, I think we already have the ingredients for inflation to come back.
All right, we're speaking with Ann Bartels, Chief Investment Strategist at Sanctuary Wealth. Thankfully, Alix Steele has made it back from her sojourn out to Calgary. She's back in our studio here.
I mean, you say that now, but wait until what comes out of my mouth in the next hour and a half.
Very good.
So anyway, I just got back, literally just got into the studio. Marianne, I noticed obviously that you were talking about being bullish and being positive and liquidity, et cetera. How does China factor into this? Because you're already feeling bullish about liquidity, regardless of what China is actually doing. Could that be a catalyst?
Yeah, yes, it can. And it's not just China. We have central banks around the world that are cutting interest rates. It is very possible as we move into next year that we get monetary stimulus that we haven't seen since COVID in 2008 and 2009. And that's what I've learned throughout the years. Even though some bad things can be happening around you, the most important thing to the market is, can companies grow their corporate profits? Markets trade on profits, not on potentials of potential risk. Now, what would change my view? Because we do have a lot of risks out there. If crude oil spiked very sharply and especially got to 100 and stayed over 100, I would view that to be extremely negative. I mean, my bullishness would turn pretty much to bearishness. But, as you mentioned, China, I think what China is doing seems very unprecedented. I'm not an expert on China, but the one thing I've learned is when central banks allow you to buy the stock market, you should buy. We saw Japan do that near its lows. In fact, the central bank actually outright bought its market. So when a central bank is allowing buying of the market, I think you should own it. I think part of the reason you've seen such a sharp move up in China is so many traders were short the market.
Right.
So we've had this major short covering, but most fund managers that manage money either globally or in emerging markets are underweight. We have a lot of room to actually move money into China.
All right, Marianne, thank you so much for joining us. Always appreciate getting your thoughts there, remaining clearly bullish there. Marianne Bartels, Chief Investment Strategist for Sanctuary Wealth.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One of the names that's under pressure here, take off about 5-6%, is Tesla. The company's first quarter sales gains this year, they come up short. The vehicle deliveries, they did rise 6.4%. Which is good, but they were trailing analyst estimates here. So again, the stock selling off a little bit. Let's get the latest with Keith Naughton. He's a Bloomberg's Auto Reporter. Keith, what are you hearing out there about Tesla and their earnings here?
Yeah, there's a little disappointment on the vehicle sales. They came in just under analyst expectations, about 1,000 vehicles under. They sold 462,000, and 463 was the consensus. But more to the point, they kind of missed the whisper expectation, which was maybe as high as 470. Seems like there's some softness in the Cybertruck. There also were high expectations for sort of a cash for clunkers sort of promotion going on in China. They've doubled the incentive for EV sales if you turn in an older model there. That was expected to give more tailwind to Tesla, and that didn't quite materialize the way that investors expected, so the stock is down.
You know, just in terms of Ubers, for example, every Uber I'm in now feels like it's a Tesla. I don't know if you guys experience the same thing. And I feel like, is that a good or bad sign for Tesla? Because, okay, it's promotional, but I feel like the reason why all the Ubers are now Teslas is because it's a promotion like, get this off my lot. Are we at the trough with that?
Yeah, Model 3 and Model Y, that is the volume of the company, which are their, mainstream cars. Their luxury Model S does not sell very well anymore. It's getting pretty long in the tooth. And Cybertruck, is priced sort of around 100,000, and that limits its volume under 20,000 probably for the quarter. So they are becoming a more mainstream brand, and when that happens, they become Ubers.
So, Matt from Westchester emails in here and says, is Tesla ever going to have a new model? We haven't had a new model like ever, really, like just an upgraded model.
Yeah, this is, sort of a long-standing issue that the product lineup, with the exception of Cybertruck, which for now is a niche vehicle, that the lineup is getting stale. But, Elon Musk is really focusing more on Tesla as an AI company. They have this event coming up next week to unveil the robo-taxi that he's really been talking up. And that's actually moved up the stock from the way he's positioning the company. So he's trying to speak less like a traditional automaker and more like an AI tech company.
I feel like it's always been that. It's been like, Tesla's a tech company. Nope, it's a car company. Nope, now it's an AI company. How does the sales, though, that we're seeing for EVs, because that's still the bread and butter, how is that stacking up against its peers like a GM or Ford?
Well, I mean, Tesla still far and away leads the market. But GM, for example, had an excellent quarter in EV sales because they've just rolled out this $35,000 Chevy Equinox electric vehicle, and that's a great price, and it's below Tesla's lowest prices. So new competitors are coming in. Tesla is supposed to have a lower priced EV coming next year, but Elon hasn't really talked much about that. So as more competitors come in, as they come in at the lower end of the market, that's going to chip away at Tesla's share.
All right, Keith, thanks so much. We appreciate that. As always, Keith Naughton, auto reporter for Bloomberg News. Tesla reporting numbers a little bit light relative to expectations.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Looking at the market, it's kind of flat here today. I think the market's trying to digest kind of what we're seeing coming out of the Middle East, what the economic impacts may be from this ongoing port strike, and maybe the political landscape as well as the traditional earnings and Fed Watch and all those types of things. But let's go to somebody who does this stuff for a living, Carol Schleif, Chief Investment Officer at BMO Family Office, and we appreciate getting some of her time. Carol, thanks so much for joining us here. Put all that stuff together, the geopolitical stuff, the domestic politics, the earnings, the Federal Reserve. Where do you guys come out and just say in your communication to your clients these days?
We remind clients a lot that the whole reason we build durable and sturdy portfolios is to be able to absorb these headlines, because it's not at all uncommon for markets to grapple with these headlines. It's interesting because we ended September with many different averages at or near all-time highs. And so investors are already a little nervous because there's that human bias to try to figure out where the risk is going to come from. And when you get a day like yesterday, where all of a sudden it's a 1, 2, 3 punch, a lot of times investors can be concerned in the short run. But it's interesting when you look through it. And the nice thing is we're going into earnings season. So we'll get a lot of color from companies, not only about the actual earnings that they've reported, but their outlook for what's coming next and how they're going to absorb all of the shocks from this. But when you look at the last few quarterly reports, especially the big months of quarterly reports, markets have actually done well because the fundamentals have come through and our companies have proven very resilient. So having portfolios, reminding investors that we've got some fixed income in there for stability, we've got some growth bias in there because the underlying trends are very positive, has been a great place to be.
Well, it also goes to the other point of how many bullish catalysts there are out there right now. And I'll break it down. Okay, we got margins could actually be better than expected as interest rates wind up coming down. You also have, as you pointed out, earnings, and expectations have been revised lower, so the bar is pretty low. The Fed is cutting 25 or 50 in November, but they are cutting. Stimulus from China, definitely fiscal spend from the U.S. government, no matter who wins the White House. I'm struck, like, what is the downside? Like, how do you not buy equities in this market? And plus, excess liquidity is really high.
Well, and I think that's why a lot of times it's called the wall of worry, because the market keeps grudgingly hitting new highs, but you're not seeing the traditional exuberance or ebullience that would mark a market top. And so from that perspective, there is a substantial amount underneath. And actually, you can make an argument that a lot of business activities actually been held in reserve because everyone for the last 2 years has been fearing a recession around every corner, and interest rates were high. Now you've got a reversal of those. We've got a lot of people saying, well, geez, maybe we averted the recession. And oh, by the way, the GDP revisions that we just had erased that technical recession that everyone freaked out about a year or two ago, because that's not even in the numbers anymore. And it goes again to how resilient these companies have been.
Carol, how about the fixed income space? Where do you see opportunities there in, again, a interest rate environment where presumably this Fed's going to continue to lower rates?
Yeah, we're preferring clients not wait around in cash. Cash has been very comfortable for a lot of people, that they at least go a bit out on the curve and lock in some of these yields that you're getting now. We're not ready to go out towards the 10-year or longer, because we actually think the 10-year yields are lower than they'll end up being, because we do believe there's an underlying growth bias. You referenced a lot of the fiscal spend that's out there. There's a lot of stuff that's been targeted, and there's thumbtacks in it, but based on some of the numbers we're seeing, less than 20% of what's been allocated is actually out there. And one of the interesting things is you've got a lot of bonding bills on state and local ballots this fall, and to the extent those get passed, you've got a lot of spending teeing up that's matched by those federal funds. And so you've got the opportunity to really put some extra growth underneath a lot of these things. And so we think as that gets absorbed, that you'll see that the 10-year yields drift higher, not lower.
So, Paul, you'll be so proud of me. I did email my guy, and I was like, hey, so I have this money in my high-yield savings. Should I put it in munis? I'm just saying, talking about where the money should go. I thought of Paul. He likes the munis. But it does raise the question of, in the equity side, where do you wind up rotating that cash? If the scenario that we all talked about in terms of the positive catalyst play out, do you rotate into the cyclicals? Do you stick with tech? Do you barbell it?
I think you barbell it, and I also think you move down the capitalization curve, because there's a lot of argument that a lot of those small caps have been very fitful at their participation. They'll participate for a week or two or a day or two, and then they'll pull it all back. And on those pullbacks, it's nice to be able to round up some of those, because they have, by and large, they're going to have better access. They're going to have more floating rate debt. They're going to benefit more disproportionately, if you will, from the Fed bringing rates down. And they're also going to participate as the economic activity stays robust in the United States.
Ellen, I want to get your thoughts on alternative investments. How do you put them in the context of the BMO Family Office in terms of asset allocation for your clients, whether it's private equity, private debt, hedge funds, that kind of thing?
Yep, private equity, private debt. We're probably less we have selective spots where we use hedge funds as much, probably not as much as we might have a decade or two ago, but a lot of private capital in general. We also have other things. We are very active in doing some custom structured notes for our clients. We look at a lot of interesting non-correlated asset classes, catastrophe bonds, some of the interesting niches in credit. The nice thing we have in terms of the private capital that we go after is we can go to smaller funds rather than the multi-billion-dollar and super big funds. Our sweet spot is some smaller funds that get a lot of less attention, if you will, and are in some very niche stuff. So our clients like it a lot.
We were just talking about Nike with Poonam Goyal, our Bloomberg Intelligence analyst, which leads me to the consumer, right? How do you play a K-shaped economy at the end of the day?
It is difficult, and it's interesting because one of the pieces that I'm preparing to write is you do have this, there's a lot of angst out there that is coming through in consumer confidence numbers and also coming through in polling numbers, but you've got, the odd part is the top 20% of the populace produces 40% of the GDP activity. The bottom 20% produces 9%. So that top 20% is really going to drive the overall macro number. But interestingly enough, that bottom 20% has a chance to drive what happens at the ballot box in 5 weeks. And to the extent that they turn out and vote, you have a chance to shape policy intermediate and longer term. And so we do a lot of talking like that because obviously our clients are going to sit at that top portion and they're going to be in a very different scenario. But their kids, their grandkids, are looking at a lot different environment because they're finding it difficult to find daycare, difficult to find houses. They're over indebted in a lot of cases with college debt, things like that. So it really is difficult. And we have a lot of those conversations one by one.
All right, Carol, thank you so much for joining us. Carol Schleif, she's a Chief Investment Officer for BMO Family Office, joining us there via the Zoom thing here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our inactive broker studio right here in Midtown Manhattan. As Charlie was just talking about, WTI is up by about 0.7%. We're trading at 70.34. The latest headline that just crossed from the Wall Street Journal is that apparently key members of an alliance made of OPEC Plus agreed to ease curbs in December. This is at an online gathering that took place on Wednesday, and according to delegates in the cartel, basically OPEC Plus has taken oil off the market, and they need to find a time to put it back onto the market, whether it's going to be a slow drip, whether it's going to be a full stop, or whether they're going to have to cut again in order to support the oil price. All of that surrounding the oil market right now. Ellen Wald is president of Transversal Consulting and senior fellow at Atlantic Council, and she joins us now. What is your read-through on that headline?
Yeah, I think that this headline, it comes after a couple of interesting headlines from Saudi Arabia saying, they're worried about oil going down maybe to 50, or they're not pursuing $100 oil anymore. I think that this is really reflective of a process that OPEC has been going through over the past quarter, maybe even half a year at this point, where they're looking at the market. They know they've got to start unwinding these cuts that they've had in place for a long time, but they're really conscious of where the market is going, what demand looks like in China, and what they have to do to kind of ease the market into accepting that, yes, they are going to be putting more oil on the market. They've already delayed the return of this oil. It was supposed to start coming back on the market in October, and they're really just, they're pushing it, back to December, but they're saying, yes, we still plan on doing this. I do think, as you mentioned before about Iraq and Kazakhstan and some overproduction going on there, it's entirely possible that they will be excluded from this increase in oil output, because the way that it works is each member only increases a certain percentage. So each individual member is only going to be putting on really a very minimal amount of barrels. They may exclude those members that had been overproducing from this in order to prevent, too much oil from flooding the market.
Hey, Ellen, Javier Blas, who is a Bloomberg Opinion columnist covering the energy space, he's out with a a note today saying that the oil price that matters now is $50, not that $100 fabled $100 barrel target. That's not relevant anymore. Maybe the new target's 50. What do you think about that?
That's an interesting conception. I do think that there is definitely we've kind of switched from, how high is it going to go to how can we prevent, there from being kind of a bottom. I do think that he's saying this in part because the Saudis have definitely been hinting at the prospects of, they have the potential and the ability to flood the market with oil and push prices down. And that's really the only leverage that they have to get other OPEC members and other OPEC Plus members in line and to keep them in line and adhering to their quotas. And so the Saudis say, look, you're not adhering. We can flood the market. We can open the floodgates and we can, increase our production up so high that prices will go down maybe to 50 and maybe even lower, as we've seen in the past. And that will have a major impact on the ability of these other countries to bring in revenue. But for the Saudis, it's really not that big a deal. They can take it, whereas those countries will really significantly be hurt. And so I don't think that this is a threat that they're making idly, but I don't think it's around the corner. I think you'd have to have some pretty severe actions, to see the Saudis go through with this.
Yeah, and then to that point, their break even for oil prices is super low, but their fiscal break even is like 85. So they can just pare back spending domestically if they need to support that. The last time they flooded the market, it was to hurt shale producers, and I find it interesting that this time, if they wind up sort of rolling back those cuts, it's to force compliance among its own members. It's just an interesting twist. Before we let you go, how much geopolitical risk premium is in the oil price right now, and how much do you think should be in the oil price right now?
So that's a great question. I do think there is some geopolitical risk premium. We've seen prices reacting to events, maybe, 2%, 3% is geopolitical risk premium. I think, it's hard to kind of divvy that up between the Middle East, between Russia. I think that any kind of risk premium that's associated with the idea that Iran might say, close the Strait of Hormuz is really not well-founded, because this is not the same environment that we saw in the 90s or the 80s or even the early 2000s. Iran is not going to close the Strait of Hormuz. It's not even clear they can physically do that, but doing so would so anger China. And China is now the main customer of, it's Iran's main customer, it's Saudi Arabia's main customer, it's the main customer of all of the Middle East oil producers. And that would so anger China that the consequences would be such that they would be devastating. So I don't see any reason why Iran would do that. I do think that there is an elevated risk in the Red Sea, and that's really where analysts should be keeping an eye on in terms of the potential for some serious disruption.
All right, Ellen, thank you so much for joining us. Ellen Wald, she is a president at Transversal Consulting and a senior fellow at the Atlantic Council, and she is one of our go-to voices on all things global oil.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.